So, imagine you just took a final exam
Okay.
and, you fail it completely, just total disaster. But then the school says you are legally allowed to grade it yourself.
Oh, nice.
Yeah, using this highly complex mathematical model that surprise proves you're actually a genius.
I mean, I would love that school.
Right. Well, on Wall Street, that is essentially the magic of something called adjusted EBITDA. And in early 2026, SoFi Technologies used it to report just a massive billion-dollar profit.
Yeah, it was capping off what was supposed to be literally the greatest year in their entire 15-year history.
It stacks.
The mood around the company was just euphoric
Right.
because for a decade they had been this fast-growing but cash-burning digital bank.
Right, burning a ton of cash.
Exactly. And then suddenly they announced record revenue, hitting $3.6 billion, up 38%.
Which is huge.
It is. And they post their first full year of real bottom line GAAP profit, roughly $370 million.
Okay, so real profit.
Yeah, under standard accounting rules. But the crown jewel, the metric management blasted across every single presentation, was that adjusted EBITDA number.
The self-graded exam.
Exactly. $1.05 billion, up 58% year over year.
Wow. I mean, that number just felt like the ultimate vindication for anyone who bought into the story. This narrative of a branchless bank living entirely inside a smartphone app.
Right. The whole traditional banking is dead, and SoFi is the replacement story.
Yeah. But then, you introduce the world of activist short selling into the mix, and that beautiful, pristine scoreboard just gets completely shattered.
Oh, totally shattered.
Because on March 17th, 2026, Muddy Waters, which is the short selling firm run by Carson Block, they dropped this 28-page bombshell of a report.
And the title alone is just aggressive.
Oh, it's wild. They called it a financial engineering treadmill leaving management fat. Shareholders the biggest loser.
Which, I mean, that is a deliberate provocation.
Yeah, they aren't pulling any punches.
No, Muddy Waters isn't just saying, oh, SoFi stock is a little too expensive right now. They are alleging that roughly 90% of that $1.05 billion adjusted EBITDA figure is just, well, entirely manufactured.
Like a mirage.
Exactly. A mirage built on accounting loopholes. They argue the real economic profit of the business should be closer to $103 million.
Wow, from $1 billion down to $100 million.
Yeah. And to twist the knife, they allege there is $312 million in debt that is mysteriously miscategorized or just like missing from the public disclosures.
Okay, let's unpack this. Because the mission for today's deep dive is to break down the behind the moat brief on SoFi, the Muddy Waters report itself, and SoFi's SEC filings. We need to understand the mechanics of how you even allegedly fake $1 billion.
Right.
But before we go any further, we need to set some very hard boundaries for you listening today.
Yes, absolutely.
This deep dive is purely for educational purposes. We are looking at a highly contentious, incredibly complex financial dispute, so we are not offering investment advice.
No investment advice at all.
Right. We are not giving you price targets, and this is absolutely not a recommendation to buy or sell SoFi stock or, any other security.
And we really have to emphasize this. SoFi disputes these allegations in full.
In full.
They have categorically denied the claims in the Muddy Waters report. They called them factually inaccurate. And nothing we are discussing today has been independently verified by us.
Yeah, we are just the messengers here.
Exactly. We are simply taking the source material and breaking down the arguments so you can understand the plumbing of the financial system.
And speaking of that plumbing, we actually want you to look at it yourself. So if you check the description of this deep dive right now, you will find a link to a companion page.
Yeah, it's got over a decade of SoFi's financial history on it.
Right, and an interactive valuation workbench, plus the full written brief with all the charts, graphs, and primary sources. Don't take Carson Block's word for it, and don't take SoFi's word for it either.
Right. Click the link, jump into the data, and explore it as we walk through this.
Okay, so because this entire dispute rests on how you interpret that raw data, let's ground that acronym we threw out earlier, adjusted EBITDA.
Yeah, let's do that. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Which is a mouthful.
It is. Historically, it was created back in the 1980s during the whole leveraged buyout boom. It was just a quick way to see how much cash a business was generating to pay off its debt, before the accountants got involved with all the depreciation schedules.
Right, but the operative word in SoFi's case is adjusted.
Yes, the adjustments.
This goes back to my exam analogy. EBITDA is a standard metric, sure. But adjusted EBITDA is where a company's management team gets to decide which expenses just, don't really count.
Yeah, they get to curate the numbers.
Like, if you have a bad quarter because you had to pay a massive legal settlement, you just call it a one-off, non-recurring expense,
Hmm.
and you add that money back into your profit column.
Or if you pay your employees a ton of money in stock options instead of cash, you add that back too.
Exactly. You're effectively grading your own homework.
And the justification companies use for this is that these adjustments show the true operational run rate of the business,
Hmm.
ignoring the noisy one-time events.
But the danger is if a company has a quote-unquote one-time catastrophic expense every single quarter, well, it's not a one-time anomaly anymore.
Right.
It's just the cost of doing business.
Exactly. And SoFi argues their adjustments are completely standard for a high-growth tech company. But Muddy Waters looks at those exact same adjustments and sees a smokescreen. A smokescreen designed to hide a business model that is, in their view, structurally unprofitable.
Okay, so to really gauge the credibility of a claim like that, we have to look at the source. Because if some, anonymous guy on Reddit posts a 28-page PDF claiming a huge bank is faking its numbers, you just ignore it.
Yeah, you wouldn't even read it.
Right. But this is Muddy Waters.
Yeah. Carson Block and Muddy Waters operate in this very specific, highly controversial corner of finance called activist short selling.
Okay, explain how that works for people who might be new to it.
Sure. So most of the time when you buy a stock, you are going long. You buy it at $10, you hope it goes to 20, and you sell it for a profit.
Simple enough.
Right. A short seller reverses the timeline. They borrow shares of a company from a broker. They sell them immediately into the open market at $10, and then they wait.
They wait for the price to drop.
Exactly. They are praying the company struggles and the stock price falls to, say, $5. When it does, they buy the shares back at that cheaper price, return the borrowed shares to the broker, and they pocket the $5 difference.
But Carson Block doesn't just quietly place a bet and hope the company has a string of bad luck.
No, not at all. He actively tries to bring about the bad luck.
Right.
The Muddy Waters business model is to fund these incredibly deep, expensive investigations into companies they suspect of fraud. Once they gather all the evidence, they take a massive short position, and then they publish their findings to the entire world.
They go on financial television, they tweet it out, basically screaming from the rooftops that the stock is toxic.
Yes, and the financial incentive there is just glaring. They are publicly trashing a company specifically to drive the stock price down so they can profit from their short position.
And, I've always struggled with the ethics of this. It feels legally gray at best. You are financially incentivized to destroy a company's market cap, and you control the release of the negative information.
Yeah.
Isn't that incredibly convenient? How is that not just textbook market manipulation?
Well, what's fascinating here is that it's a completely fair criticism, and regulators constantly scrutinize activist short sellers.
I would hope so.
Yeah, but the defense for this model, and really the reason it's allowed to exist, is that the massive conflict of interest is entirely transparent. Everyone knows Carson Block is short the stock.
Right. He admits it up front.
Exactly. And because of that, nobody is going to take his word on blind faith. If he just posts a vague rumor, the market will ignore him, the stock will go up, and he will lose millions of dollars.
Okay, that makes sense.
Right. To actually move the market and overcome his own obvious bias, his reports have to be impenetrable. He has to bring primary documents, obscure court filings, global shipping manifests, undeniable proof. The burden of evidence on a short seller is extraordinarily high.
And we should acknowledge that he has met that burden before. Muddy Waters built this terrifying reputation by finding actual catastrophic frauds that the SEC, the auditors, and the big Wall Street banks completely missed.
Oh, absolutely. The classic example is Sino-Forest in 2011.
Oh, yeah.
This was a multi-billion-dollar Chinese forestry company listed on the Toronto Stock Exchange. Everyone loved it. And Muddy Waters comes out and says, this is a near-total fraud. They are literally fabricating the timber they claim to own.
Which is wild. How did they figure that out?
Well, the Sino-Forest case is fascinating because it wasn't just an accounting dispute. It was a physical investigation. Muddy Waters investigators actually went to rural China. They tracked the trucking routes.
Oh, boy.
Yeah, and they realized the dirt roads leading to the supposed massive timber assets couldn't physically support the heavy logging trucks required to move the volume of wood the company claimed to be selling.
That is incredible.
Right. They checked local land registry files and found the company didn't even own the land it claimed on its balance sheet. When they published that data, the stock collapsed almost immediately.
And they were right.
Yes, regulators stepped in, the company went bankrupt, and regulators proved Muddy Waters right.
And they did something similar in 2019, right, with a company called NMC Health?
Yes. And this wasn't some obscure overseas listing. This was a blue-chip hospital operator in the FTSE 100 in London, a massive, respected company.
Right.
Muddy Waters published a report alleging they were manipulating their cash balances and hiding debt. And again, the market panicked. Months later, NMC Health admitted they had over $4 billion in off-book debt that they had just, hidden from auditors.
$1 billion.
Yeah. The company collapsed. So when a firm with that specific track record points a finger at SoFi, the entire financial sector stops to read the report.
But we cannot treat a Muddy Waters report as a guilty verdict.
No, absolutely not.
Because they have been wrong.
Yes, they have. A notable example is Burford Capital. Muddy Waters took aim at them, heavily criticizing their accounting, but Burford's management didn't crumble. They fought back aggressively.
They rebutted the claims.
Point by point. They released incredibly detailed rebuttals, breaking down their cash flows and fundamentally proving the short seller's thesis was flawed. The stock took a huge initial hit, sure, but it recovered over time.
And Muddy Waters probably took a painful loss on that one.
Likely, yes.
Yeah.
So Carson Block is a formidable investigator, but he is still just placing a bet. He is not a judge.
Okay, so that establishes the stakes and the players. Now we need to look at the target. Because you can't understand how SoFi is allegedly engineering its profits until you understand the machine they are actually operating.
Right.
What exactly is SoFi in 2026? Because they didn't start out as a bank.
No, they started roughly 15 years ago with a very narrow, specific product, refinancing student loans for high-earning graduates.
Okay.
The thesis was simple. If you just graduated from medical school or law school, you have a ton of student debt, right? But you also have a phenomenally high future earning potential.
Right. You're going to be rich eventually.
Exactly.
Yeah.
Traditional banks were pricing those student loans based on the borrower's lack of current assets. SoFi stepped in and said, we know these doctors and lawyers are going to make a lot of money, so we will refinance their loans at a much lower rate. It was a highly profitable, low-risk niche.
But refinancing student loans for dentists doesn't get you a multi-billion-dollar valuation. To grow, they had to expand.
Yeah, significantly.
And today, the business operates on 3 distinct pillars. Let's walk through them. Pillar number 1 is lending. The source brief calls this the engine room of the company.
Yes, this is the profit driver. It's where the vast majority of their actual revenue is generated. They originate student loans, home mortgages, and personal loans directly to the consumer.
And the personal loans are the critical piece of this entire puzzle, right?
Absolutely. Because unlike a mortgage, where the bank can foreclose on your house if you stop paying, a personal loan is completely unsecured.
Right. If I borrow 30 grand to renovate my kitchen and then lose my job, the bank has no house to seize.
Exactly. They just have to eat the loss.
Yeah.
And because of that inherent risk, personal loans carry much higher interest rates. SoFi charges its personal loan borrowers around 13%, sometimes higher depending on the macro environment.
Okay.
Those high-yield personal loans are the most lucrative part of SoFi's business. And as we'll see, they sit at the absolute dead center of the Muddy Waters controversy.
Which naturally leads us to pillar number 2, financial services. This is the front door of the app. It's the checking account, the savings account, the debit card, the stock brokerage. And individually, these products don't make SoFi much money, do they? In fact, I think they often operate them at a loss.
They do. It's the classic loss leader strategy. You offer a beautifully designed app with zero fee checking and a great interest rate to acquire the customer cheaply.
You come for the free checking account, and they stick around to sell you a highly profitable personal loan.
Exactly. Once they use your app every day to check their balance, you have a captive audience. But there is a second, even more important reason for this front door. In 2022, SoFi achieved something very rare for a fintech startup. They secured an official national bank charter.
Okay, why does a bank charter matter so much? I mean, before they had it, if SoFi wanted to lend me $20,000, they didn't just have that cash sitting around in a vault.
No, they had to go to a giant Wall Street bank, borrow that money on a warehouse line of credit at, say, 5% interest, and then lend it to you at 9%.
So their profit was just that narrow 4% spread in the middle.
Right. Their cost of capital was determined by larger banks. But the moment they got the bank charter, they were legally allowed to take retail deposits. So now, when 1 million young professionals open SoFi checking accounts and deposit their paychecks. SoFi can use that massive pool of cash to fund their lending operations. They pay the checking account user maybe 1 or 2% interest and lend that exact same money out as a personal loan at 13%.
Oh, wow, the margin explodes.
Exactly. The bank charter fundamentally transformed their unit economics.
And then you have pillar number 3, the technology platform. This is the plumbing.
Right. Over the years, SoFi acquired 2 major tech companies, Galileo and Technisys. Think of this as the back-end software rails.
Basically, they rent this out to other fintech startups.
Yes, so those startups can issue cards without building an entire bank from scratch. It's a smaller slice of SoFi's overall revenue, but management loves to highlight it because it positions them as a tech company, not just a bank.
Okay, so you look at that entire ecosystem, the highly profitable lending engine, the digital front door fueled by cheap deposits, and the tech rails. Wall Street analysts love to talk about SoFi's moat.
Yeah, this supposedly impenetrable fortress.
But we have to be realistic about what a moat actually is in digital banking.
Totally. I mean, having a bank charter is a great regulatory hurdle, but deposits are a commodity.
Right. If another app offers 0.5% more on a savings account, transferring your money takes 3 taps on a screen.
The switching costs are virtually zero. So the real question Muddy Waters is posing isn't whether their moat is wide, it's whether the massive profits they are reporting inside that app are actually real.
Which brings us to the absolute core of today's deep dive. The 28-page Muddy Waters thesis is built on 4 distinct mechanisms of alleged fraud and financial engineering. We are going to go through these one by one because this is where the math gets pretty fascinating. Mechanism number 1 revolves around something called fair value accounting and the charge-off rate.
Okay, this is the bedrock of the entire dispute. So when a traditional conservative bank originates a loan, they usually hold it on their balance sheet at the amortized cost. Meaning they only recognize the profit slowly, month by month, as the borrower actually pays the interest.
That makes sense.
But SoFi operates differently. Because they frequently sell their loans to other investors, they classify them differently under accounting rules, which allows them to use fair value accounting.
Let me try to translate this into plain English. Fair value accounting is essentially counting your chickens before they hatch.
Exactly.
But doing it with a highly complex mathematical model to predict exactly how many eggs will break. SoFi books the estimated future gain of a loan today, years before collecting the actual interest.
That is a perfect analogy. They are pulling future projected profits into the present day. Now, the single most sensitive variable inside that mathematical model is the default assumption, officially known as the charge-off rate.
Okay, the charge-off rate. I like to think of this as the percentage of friends you lend dinner money to who simply will never pay you back.
Yeah, exactly. It's a percentage of the loan portfolio the bank expects to write off as a total unrecoverable loss.
Right.
If your mathematical model assumes a very low charge-off rate, it means you expect almost everyone to pay you back. Fewer expected losses mean the projected value of the loans is much higher, which means the upfront paper gain you get to report to Wall Street today is massive.
So here's the specific discrepancy. SoFi reports a very low 2.80% charge-off rate.
Yes.
That's a very healthy, very low default rate for unsecured personal debt. But Muddy Waters dug into the underlying loan data and claimed the 2.80% figure is a complete illusion. They argue the true default rate is 6.1%.
More than double what SoFi is telling the market.
Right. And the implications of that are staggering.
Oh, massive. Muddy Waters estimates that by using the 2.82% rate, SoFi was able to overstate their day one paper gains on personal loans by about $259 million in a single year.
But wait, I have a massive problem with this theory. How do you fake a default? A default is binary, right? The borrower either made their monthly payment or they didn't.
Right.
If the money isn't in SoFi's bank account, how can they possibly hide that from the official 2.80% charge-off metric?
Okay, the answer lies in a specific banking regulation regarding delinquency. Standard accounting rules dictate that if a borrower misses payments for 120 days, roughly 4 months, the bank must officially declare that loan dead.
Okay.
They have to charge it off, take the loss, and let it hit their official default metrics.
Ah, the 120-day cutoff mark.
Yes. So Muddy Waters alleges that SoFi engages in a frantic game of hot potato. Right before a batch of toxic non-paying loans crosses that 120-day threshold, SoFi bundles them up and sells them off to a third-party buyer.
Wow.
Because the loans are sold just before the deadline, they never officially trigger the charge-off requirement on SoFi's books. The reported metric stays pristine at 2.80%, even though the underlying loans were rotting.
This is where the specific details in the report get incredibly wild. Muddy Waters highlights a transaction where SoFi had a massive pile of defaulted loans, $62.5 million worth of debt that people were not paying back.
Right.
And SoFi sold that entire $62.5 million pile to a relatively unknown buyer for just $5.0 million.
They sold it for 8 cents on the dollar.
8 cents. They willingly took a 92% haircut, wiping out tens of millions of dollars in actual value, seemingly just to get those loans off their balance sheet before the 120-day clock ran.
Exactly. By taking the massive hit on the sale price, they protect the integrity of the 2.8% model. And Muddy Waters claims they use off-balance sheet vehicles to hide other distressed debt as well. The accusation is that the model isn't predicting reality. Reality is being manicured to fit the model's need for upfront profit.
Which transitions us perfectly into mechanism number 2. This mechanism shifts our focus from personal loans to SoFi's original product, student loans. And here, the dispute isn't about hiding defaults. It comes down to one single absurdly low number, the discount rate.
Okay, the discount rate. It is essentially the risk penalty applied to future money.
Like going back to the bird in the hand is worth 2 in the bush.
Right. The discount rate is the mathematical formula that decides exactly how heavily you discount those birds in the bush based on how dangerous the bush is.
I like that.
If I promise to give you $100 tomorrow, you don't discount it much. If I promise to give you $100 in 10 years and I have a terrible credit score, you discount it heavily. A higher discount rate means future payments are worth less today.
So when SoFi originates a student loan that will be paid back over a decade, they have to apply an annual discount rate to figure out what that future stream of payments is worth today so they can book their upfront fair value gain.
Exactly. The riskier the borrower, the higher the discount rate.
Right.
And the higher the discount rate, the smaller the upfront paper profit.
So if you are SoFi, you want to use the lowest discount rate possible. What was the allegation here?
Muddy Waters pulled the 2025 SEC filings and found that SoFi discounted a massive tranche of its student loans at just 3.89%.
3.89%. Okay, let that sink in for a second. Why is that specific number a problem?
Because you have to compare it to the risk-free rate. The risk-free rate is the yield on a 10-year U.S. Treasury bond. When you buy a Treasury bond, you are lending money to the United States government.
Which is considered the safest investment on earth.
Right. Because they have a printing press. They can just print dollars to pay you back. No other entity can do that. Therefore, every other loan in the world must carry a higher interest rate to compensate for the additional risk.
Okay, so what was the yield on a 10-year U.S. Treasury bond at the time? SoFi used the 3.89% discount rate.
The 10-year Treasury yield was 4.16%.
Wow.
It was 0.27% higher than SoFi's discount rate.
That is mathematically insane. Using a rate lower than the U.S. Treasury yield mathematically implies that a pool of unsecured 20-something college students is a safer bet to pay back their debts than the United States government.
Or a blue-chip company like Coca-Cola. It makes no sense.
And meanwhile, SoFi is charging personal borrowers, like 13%.
Right. The contradiction is glaring. You charge retail customers 13% because of unsecured credit risk. But when it comes time to value your own assets for Wall Street, you apply a discount rate lower than sovereign debt.
Just to pump up that day one paper gain.
Exactly. Muddy Waters calculates that this artificially pumped up SoFi's paper gains by roughly $247 million.
This brings us to mechanism number 3. Financed loan sales and the Cantor loop. And I have to admit, if the loans are secretly defaulting and the student loans are bizarrely mispriced, how on earth is SoFi managing to sell these loans to Wall Street investors? You can't just sell terrible loans at full price.
Right. Wall Street buyers do their own due diligence. This is the crux of the issue. A fair value model is supposed to reflect the price an independent buyer would pay in a free market. If SoFi is regularly selling these loans at full price, it validates their internal models.
So how do they move bad product at a premium price?
Well, before we explain the Muddy Waters theory, we need to quickly define 2 industry terms: forward flow and securitization.
Okay, definitions. I can do securitization. It's like throwing a bunch of individual IOUs into a blender to make a financial smoothie.
I love the financial smoothie analogy.
Right, and then you sell sips of that smoothie to Wall Street investors. They aren't taking the risk on one specific guy defaulting. They are buying a blended statistical average.
Exactly. And a forward flow arrangement is a contract where an institutional buyer agrees in advance to purchase a steady, ongoing stream of those IOUs or those smoothies over time. It guarantees the lender a constant outlet.
Okay, and those are completely standard plumbing and finance. There's nothing wrong with them. But Muddy Waters alleges that SoFi is essentially staging these sales by financing the buyers themselves.
Right, they claim SoFi uses seller financing. When SoFi goes to sell a massive pool of these 13% yielding personal loans, the buyer doesn't actually use their own money to buy the entire pool. Instead, SoFi allegedly lends the buyer roughly 80% of the purchase price.
Wait, what?
Yeah. And they lend that money to the buyer at an incredibly low subsidized interest rate, somewhere around 5%.
Okay, let's walk through the incentives of that. I am SoFi. I say to a buyer, I will loan you 80% of the money you need to buy my product, and I'll only charge you 5% interest. You take that cheap money, buy my loans that pay 13%, and you pocket the 8% spread, basically risk-free.
That is the allegation.
But if you are financing the buyer of your own product, did you really sell it? Can you really use that sale to prove the market price of your loans to your auditors?
It feels completely circular.
Yeah.
And Muddy Waters highlights the mechanics of this with something they call the Cantor loop.
The Cantor loop. Tell me about this.
Muddy Waters tracked the flow of these loan pools and found that in some instances, they didn't go straight from SoFi to the end buyer. They were passed through the brokerage firm Cantor Fitzgerald.
Okay, a big Wall Street name.
But Cantor didn't hold them. According to the report, Cantor held the loans for literally a single day, 24 hours. They collected a tiny spread, about $375,000 as a transaction fee, and then immediately passed the loans on to the ultimate end buyer, who was financed by SoFi.
Why bother with the 24-hour layover? Why pay Cantor $375,000 for one day of work?
Under the short seller's interpretation, it is entirely about optics. By inserting a prestigious Wall Street name into the middle of the chain, even for 24 hours, it legally breaks the direct link between SoFi and the SoFi-financed end buyer.
It makes the transaction look like a standard arm's-length market sale?
Exactly. It adds a thick veneer of regulatory legitimacy to a structure that Muddy Waters argues is actually highly circular.
Which perfectly sets up mechanism number 4, the disputed $312 million. And honestly, this final mechanism is the easiest to judge because it relies on two totally contradictory documents. There is very little gray area here.
Yeah, this is a very clean test of management's credibility. To understand it, we just need to define a UCC filing.
UCC stands for Uniform Commercial Code. I like to compare a UCC filing to a public dibs tag. It's like slapping a Post-it note on a car at the DMV saying, if this guy doesn't pay his debt, the car belongs to me. It's a lender's formal claim on collateral.
Perfect definition. So let's look at the timeline. In September 2024, the SEC sent SoFi a comment letter. They were questioning SoFi about these complex loan sales, asking if they truly met the accounting criteria for a sale.
Okay, regulatory scrutiny.
Yes. Muddy Waters alleges that immediately following this, SoFi quietly borrowed about $312 million against a pool of their loans. But this debt never hit its public debt disclosures.
So how does Carson Block know it happened?
Because his team found the public UCC filings. The filings clearly show SoFi retaining a secured lender's stake in these specific loans. If you maintain a claim on the collateral, you haven't executed a true sale. It's a secured borrowing.
But here's the massive contradiction. Shortly after these UCC filings were made, SoFi held an earnings call, and the CFO explicitly told investors they sold $312 million of senior secured loans at par.
At par, meaning for 100% of their face value.
So you have a public UCC filing showing SoFi retaining a lender stake and a CFO on an earnings call claiming they were sold outright. Sold or still holding? It cannot be both.
Right. One of those representations has to be false. And Muddy Waters claims the motive for all four of these mechanisms is management bonuses.
Follow the money.
Always. The executive bonuses are tied to book value. A single honest write-down admitting the fair value models were too optimistic would completely wipe out their bonuses. They are financially incentivized to keep the treadmill running.
Okay. We have laid out the prosecution's case in agonizing detail. But SoFi did not just sit quietly and take this. How did they respond? Section 4 of our dive, the defense and market reality.
Their institutional response was immediate. Within hours, SoFi issued a full denial, calling the report factually inaccurate and misleading, and even threatened defamation action.
But talk is cheap. Any PR department can draft an angry press release. The more compelling defense came from the CEO, Anthony Noto.
Yes. Anthony Noto went into the open market and bought hundreds of thousands of dollars worth of SoFi shares with his own personal capital.
I mean, that is the ultimate signal of conviction. The guy who knows the books best isn't running for the exits, he is doubling down. You have to put that heavily on SoFi's side of the ledger.
You do. And if we connect this to the bigger picture, there is a massive institutional wall defending SoFi's accounting. Fair value accounting isn't a trick SoFi invented in a dark room. It is standard U.S. GAAP accounting.
Right. And those financial statements are audited by Deloitte, which is a Big Four accounting firm.
Exactly. By accusing SoFi of a massive accounting fraud, Muddy Waters is alleging that Deloitte either completely missed a billion-dollar deception or was actively complicit, which is a very high bar to clear.
And what did Wall Street think? Did other banks defend SoFi?
Yes. Mizuho's banking analysts reviewed the Muddy Waters report, called it serious, but ultimately concluded it misunderstood key facts about how loan sales and discount rates function under GAAP rules. They maintained a positive rating on SoFi.
So, with all this gasoline poured on the fire, what did the market actually do when the report dropped?
The market's reaction was, honestly, incredibly muted. Wall Street's theater had a flat opening night. The stock barely moved the day the report dropped.
The big institutional investors just kind of shrugged.
Yeah, but it has slowly, agonizingly drifted downward over the months since. It's unresolved weather in a nervous market.
Which brings us to Section 5, the ledger. What is not in dispute? If we strip away the accounting war, what are the undeniable facts both sides agree on?
Fact 1. The real growth. Record $3.6 billion revenue and massive user and deposit growth. That is totally real.
Okay, but fact 2, the hidden cost.
Yes, the dilution. SoFi issued about 14% more shares in a single year. And this is the core lesson for listeners today. The massive difference between reported paper profit and actual cash collected.
Right, because the paper profit is dictated by a mathematical model.
Exactly. Because the profit is on paper, a fast-growing lender has to keep issuing stock to fund its actual day-to-day operations.
You can't pay software engineers with a fair value markup.
Right. You need real cash. So they print new shares, which dilutes the shares you already own.
So what does this all mean for you? We have laid out the mechanics of the dispute. Who do you believe?
Right.
Do you believe a motivated short seller who has successfully exposed massive frauds before? Or do you believe a management team backed by standard accounting rules and Big Four auditors? We aren't going to resolve it for you.
No, we really want you to explore it yourself.
Yes, check the episode description for the companion page link. Don't take Carson Block's word for it, and don't take SoFi's word for it. Jump into the interactive valuation workbench and the 10 years of financial history linked in the description.
And a final reminder, this has been strictly for educational purposes. We are not giving investment advice, setting price targets, or telling you to buy or sell. SoFi completely disputes these allegations, and we have not independently verified them.
As we wrap up this deep dive, we want to leave you with a provocative closing thought. When you are evaluating a situation like this, with a credible, complex fraud allegation hovering over it, how do you measure the risk?
The author of the brief ends with a quote from Warren Buffett about unknowable tail risk. He said, "If you hand me a gun with 1,000,000 chambers in it, and there's a bullet in one chamber, and you said, put it up to your temple, how much do you want to be paid to pull it once? I'm not going to pull it. You can name any sum. The downside is fairly clear. I'm not interested in that kind of game."
1,000,000 chambers, one bullet. Is investing in a company with this kind of shadow hanging over it a 1,000,000 chamber game you want to play? We'll let you decide.